Welcome to Ben Talks Money.
Hello and welcome back to Ben Talks Money. My name is Ben. I have an MBA in Finance and Management, and I have been trading for the past 8 years. If you are new here, I would love to invite you to subscribe to the channel, like the video, share, and please help me grow the channel. So in today's video, we will talk about options and when is it best to use options instead of buying the stock. So let's get started. First of all, what are options? So options are financial contracts that gives you the right to buy or sell a stock at a specific price within a specific time frame. So the options gives you the right, not the obligation, because you can decide to sell the option anytime you want, whether the premium is appreciating or not. You can decide to sell your options at any point in time. So it gives you the right to sell or to buy the stock at a specific price in a specific time frame. Think of an option like a coupon that locks in a price of a certain transaction. So you are paying a certain price to lock in the transaction. That's what option is. So, and it helps you limit your risk because the only money that you are losing is the premium that you are paying for the right. And it helps you also leverage your position, especially if you have a small account. So the key components of an option are four. The first one is the underlying asset. That is whether it's an ETF or a stock. So let's say, practically, let's use Apple. An Apple option, if you buy a call or a put option, the underlying asset will be Apple. The premium is the price that you are paying for the contract, the price that you are paying for the right to buy or sell the stock at a specific price in a set time of frame. And the strike price is the set price based on the contract. Let's say Apple stock is trading up around $245 right now, and you're buying a $250 call option. The strike price is $250. So that is the strike price. It's the predetermined price at which you buy or sell the underlying asset. And the fourth one is the expiration date. The expiration date is the deadline for the contract. So after the expiration date, you don't have that right to buy or sell the stock or the asset. Those are the four key parts of an option: the underlying asset, the premium, the strike price, and the expiration date. So there are two types of options, and this is different from option strategies. There are multiple different strategies, option strategies out there that you can use, but there are two types of options, and those are the call options and the put options. The call options gives you the right to buy a stock at a specific price in a set time frame. And the put option gives you the right to sell the stock at a specific price in a specific time frame. And both call and put options are time sensitive. And so the option loses the value, the premium that you paid, it loses value as time passes by, if the underlying stock doesn't move in your direction. And sometimes the underlying stock will move in your direction, but still the move might not be enough to compensate for the time decay. And that is why options are time sensitive and they're a little bit riskier if you don't know what you are doing. And it's also a good profit mechanism. It helps you grow. If you have a small account, options are the best medium to grow the small account. So let's look at a real life scenario of an option. So let's say Apple is trading at $245 right now, and then you buy a call option with a strike price of $250. So because the underlying stock is trading at $245 and you bought a $250 call option, it is referred to as out of the money because the underlying stock is not at $250. It's rather at $245. So your option is out of the money. And then let's say you bought the $250 call option and you paid $5 for it. One thing that you have to understand is that option contract comes in multiples. If you buy one contract, it has 100 shares in it. So that means that if the contract says the premium is $1, you have to multiply it by 100. So in this case, if the premium is $5, you have to multiply it by 100. So it means the premium will be $500. So this gives you the right to buy Apple stock at $250, regardless of the price. Apple stock is at $245. You bought a $250 call option. It gives you the right to buy 100 shares of Apple at $250. It doesn't matter if Apple stock will be at $1,000 at that time. You still have the right to buy the stock at $250. So let's say the stock is at $270. You have the right to buy it at $250. So you buy that $250, and right there you have a profit and a gross profit of $20. But because you paid $5 premium, your net profit will be $15, and everything is in a multiple of 100. Okay. So in this case, your $15 will be $1,500. So if you look at it, you paid $500 and the stock moved $20. This is the reason why options are lucrative. If you know what you are doing, it helps you grow your account, because not a lot of people can afford to buy 100 shares of Apple, but you can use options and make even more money than you would have made if you bought the stock. Because if you bought the stock, it moved $20. 100 shares multiplied by 20, right? But in this case, you are making 50% more than you would have made if you had bought the underlying stock. On the other hand, if Apple stock stays at $245, you lose your premium, because you have the right to buy the stock at $250, but the stock is at $245. So that means that the option didn't move in your direction, which means you lose the premium that you put in. And that is one thing about options. It gives you a calculated risk. You know exactly how much you are risking. So that is a real life scenario of using options. So then when should I use options instead of buying the underlying stock? First of all, if you have a small account and you know how to trade options, it's best to use options instead of buying the stock. As we saw in the example that I gave earlier on, the options gives you more leverage. It gives you more profitability if the stock moves in your direction. It helps you grow a small account. I grew a small Roth IRA from $1,000 to $50,000 within a year using options. Options helps you grow a small account. It also helps you limit your risk, because the only thing that you are risking is the premium. Let's say right now the stock market is hot. You have all these small caps going 100, 200% in a week or so. And sometimes they will drop 20, 30% and you blow your account, right? But if you use options, if you play it with options, the only money that you are losing is the premium that you paid. That is if you wait until expiration and the stock doesn't go in the direction that you want it to go. You lose just your premium. But the upside is unlimited. That is the sweet spot for options. The upside is unlimited, but your risk is capped. You cap your risk. Options helps you in a directional play. Like right now that you know that the stock market is hot, the stocks are hitting all-time high. It's better to buy options than to buy the underlying stock, because you know the direction of the market. So when you know the direction, when you are certain, which most of the time you cannot, but when you are certain of the direction that the stock is heading, using options is the best option in that scenario. And also, if you have a portfolio, you have the stock and you want to hedge. Let's say you've bought 1,000 shares of Big Bear AI at $5, and you think maybe I don't want to lose $5,000, because we all know that Big Bear can drop 50%, but I don't want to lose that. I don't want to lose half of the money I invested. So you can use options to hedge it. In this way, you can, if you think the stock might drop a little bit, you can sell covered calls to protect your investment. You can buy puts. So those are the ways that you can use options as a hedge to protect your portfolio and your investment. You can also use options as an income generation. I am a full-time options trader. I make my income from trading options. It's a good way of generating income. If you have a small account, again, options are the best way to grow it and also to generate income. So those are the scenarios that options are better than buying the stock. For speculation, if you think you know the direction that a particular stock is going to go, it's better to use options. If you want to generate income, the best income generator is an option strategy. If you want to hedge in your portfolio against a downturn, you can use options. Also, as your pure play, like I do, I don't buy the stocks, I don't buy the ETFs. All I do is options. Those are the scenarios that options are better than you buying the stock. Let's recap when to use options and when to buy the stock. First of all, options are better. Like, you know where the stock is going to head in the short term. Options are better. If you want to leverage your position, like hedging, options are better. If you want to generate income, then you go with options. So what about stocks? Buying the stock is better when you are just building a portfolio for the long term. You are building a portfolio because usually you can get a call option more than 2 years ahead. But if you want to build a portfolio for 5, 10, 20 years, it's best to buy the stock. If you want to earn dividend, you have to know that you don't get dividend if you buy the options. If you want to earn dividend, the best way is to buy the stock. So that's it for the video. The best scenarios to use options. And again, if you are new here, please subscribe to the channel, help me grow. And until next time, let's keep talking money.